Welcome to our video on interest rate risk. This is part of a series of videos on different types of risks and how they can affect asset class values in portfolios. So let's get started with some of the basics. What exactly is interest rate risk? It's not a very intuitive concept, but basically the idea is interest rate risk is the risk that an investment will lose value based on a change in interest rates. Interest rates are influenced by a number of macroeconomic forces. Things like monetary policy. When you hear about the Federal Reserve setting interest rates, that is certainly an important input. Inflation is also quite relevant. When things are getting more and more expensive, interest rates tend to go up. And the strength of the economy also is a factor in that as an economy gets stronger, more and more people want to borrow money to invest, and debt gets more expensive, so interest rates also increase along with it. The big takeaway here is that when interest rates go up, things are getting more expensive. Debt's getting more expensive, commodities are getting more expensive, and in general, prices are going up. So let's now understand how interest rates can affect the price of a specific security. And the example that we're going to use is bonds. Let's take a trip to the land of Canjolia, where Canjo Incorporated issues 5% bonds. Now, all of a sudden, Canjolia starts to grow as an economy. Things are getting more and more expensive. Businesses are prospering, and interest rates start to rise. Now, these businesses all want to borrow more money because everything is getting bigger and bigger. Things are growing really, really fast. And Canjo Incorporated wants to jump in on this. They want to make a number of different acquisitions. They want to start a new set of product developments, but they don't have enough cash on hand. So they need to issue new bonds in order to finance this growth. Now, remember, interest rates have increased. Things are getting more and more expensive. So Canjo Incorporated, they try to issue more 5% bonds, but no one wants to buy them anymore. So all of a sudden, Canjo Incorporated must issue 10% bonds. Remember, with the exact same risk, it's still the same company in order to find buyers. No one will buy the 5% bonds anymore because there are plenty of other good investment opportunities out there. So the cost of capital for Canjo Incorporated is increased. They must issue bonds with a higher interest rate. So what does this mean? This means that the value of the existing 5% bonds goes down. Because think about it. If I'm an investor and I can buy 10% Canjo Incorporated bonds with the exact same risk, why would I pay the same amount of money for 5% bonds? I'd much rather buy the 10% bonds. So the people who own the 5% bonds, if they want to sell them, they have to sell them at a lower value. And this means that their price goes down. So that is an example of how interest rates can affect the prices of bonds. And I'll actually talk later on in the video about how it can affect the prices of other securities as well. But let's try to understand how interest rate risk is related to inflationary risk. Basically, the idea here is that as interest rates start going up, inflation, the cost of goods and services, also goes up as well, and that can certainly affect the value and price of different investments. Let's now try to understand a comparison of asset classes. What are some of the assets that have a high interest rate risk? And what are some asset classes that are a little bit more protected? So, as I mentioned in the previous example, fixed coupon bonds, bonds that have a specific interest rate throughout their entire maturity, they tend to have a pretty high interest rate risk, and I just demonstrated that. A very similar example is fixed mortgages. If I have bought up a mortgage that is paying a fixed coupon rate over a number of years and interest rates start going up, that mortgage is going to be worth less. Probably the single riskiest investment with regards to interest rate risk actually is cash. And this is very counterintuitive because a lot of people think cash is really safe. But it's not, because think about it. If interest rates start going up, if inflation starts going up, my cash, the power of my individual dollar goes down. I might have the same number of dollars, but those dollars won't be able to buy as much. And that's really the point here, is that cash, regardless of how quote-unquote safe it is, still carries some risks, and interest rate risk is one of the big ones. Let's now move on to some of the securities that are a little bit more protected from interest rate risk. One example of this is commodities. Commodities tend to be very well hedged out against inflation because as goods and services tend to get more expensive, commodities, gold, different types of food like wheat and orange juice, those things tend to get more expensive as well. So commodities tend to go up in value when interest rates are going up. Another example of something that's relatively protected against interest rate are TIPS, which are Treasury Inflation Protected Securities. I'll actually create a whole another video about this type of asset class in the future, but the basic idea is that these are Treasury securities issued by the U.S. government that are indexed for inflation. So if inflation tends to be higher and interest rates are going up, these TIPS will pay a higher coupon rate. Now, if inflation is lower, they'll pay a lower coupon rate. As a result, you're a little bit protected from inflationary risk, from interest rate risks. The amount of money that you receive every year varies based on the interest rates. Finally, stocks are partially hedged against interest rate risk as well. They're not fully. There are some risks associated with inflation. So stocks are not the best example here, but if you think about it, buying stock is buying a stake in a company. And when things are getting more expensive, companies have to charge more money in order to reap higher profits. Things are growing, right? So stock values can possibly appreciate along with higher interest rates and higher inflation. But there are other factors in play here as well. So this is not 100% correlation by any means. The big takeaway here is that inflation and high interest rates erode purchasing power. The power of your individual dollars goes down when inflation and interest rates tend to go up. The central question is, what can your dollars buy? If you are receiving 5% a year, but those individual dollars are not worth as much, then that 5% really isn't as valuable. And that is what interest rate risk is all about. Thank you very much for watching. I hope this video has helped you understand interest rate risk and how it kind of plays into some of the different asset classes in a portfolio. And for similar videos, I recommend you check out my website, www.canjo.com.